We have this attitude around debt is bad if you're in a lower class society of America. And we just call it wealth management when you're in a higher class in America.
Prends-nous un café. Let's get caffeinated.
Today is going to be all about the money, honey. Welcome. This is Coffee and Calculated Curiosity. I am your host, Cassie Clayton, and today we are going to be getting into a Senate bill. This is 52 bills, week number 3. We've walked through a state bill, we've walked through a congressional House bill. This time we're going to walk through a congressional Senate bill. Time is money, so let's get into what this bill is covering.
Senate Bill 381.
I'm going to start right off the bat getting into Digital Democracy Project. I'm going to do this drop down and I'm going to go to bills. 10% credit card interest rate cap. S.381. Yes, this is the one that you have been hearing about in the news. 119th Congress, first session. Senate Bill 381. To amend the Truth in Lending Act to cap credit card interest rates at 10%. I mean, on the surface, if you've ever had a credit card and you know that those rates are where? Average credit card interest rate in the US for all new card offers, it's between 20% and much higher, 28% over here when it's travel cards. From 20.18% to 10%, what would that actually do? So let's get right into the bill text. Again, I like to go straight to Democracy Project first, go to the bill text, go to the bill status, and open those pages directly. You can also go straight to congress.gov, type in the bill as you know it, and pull up that same exact information. Bill text is available for us here, and we can find the status about where it's at with what committees when it was introduced. In the Senate of the United States, February 4th, 2025, Mr. Sanders, for himself, and Mr. Hawley introduced the following bill, which was read twice and referred to the Committee on Banking, Housing, and Urban Affairs. If you need to find out who Mr. Sanders and Mr. Hawley are, you can certainly do that when we look at sponsors. There's multiple places you can look at this. We can see the sponsors here on plural policy. We are seeing cross-partisanship here with an independent, Republican, and Democratic sponsors for this bill. This bill is also being talked about by the President of our United States. That's causing a lot of media attention. When we go back into the bill, a bill to amend the Truth in Lending Act to cap credit card interest rates at 10%. To know even what we're talking about here, that means we have to go look at what is the Truth in Lending Act. The Federal Trade Commission has information about the act. Truth in Lending Act was put into law, so now it is a law and it has a U.S. code. We can go look that up specifically. Here's our U.S. code, 15, in Chapter 41, Consumer Credit Protection. These things have been building on top of each other. This is a brand new bill that has been introduced to add to or inform or amend another law. So let's find out when this was passed. May 29th, 1968. Let's go find out for sure. Let's look in a couple of other places. A place that we should be able to trust when we go to look at it is congress.gov. They are supposed to be keeping records of the bills and laws for our country. We can find here the Truth in Lending Act requires creditors to disclose standardized information for various financial products and offers additional consumer protections. Applies to most forms of consumer lending, including mortgages, auto loans, credit cards, which is what we're talking about today, and payday lending. The Consumer Financial Protection Bureau has rule-making authority over the Truth in Lending Act and its implementing regulation. The CFPB shares supervisory and enforcement authorities with the Federal Trade Commission. In 118th Congress, legislation has been introduced relevant to the Truth in Lending Act that would clarify the types of products that should be covered. modify or impose new pricing caps, offer regulatory relief for financial institutions, and modify disclosure agreements requirement. This act was first enacted in 1968. How many years has it been since 1968? It's been 58 years since this Truth in Lending Act was passed into law. Think about in 1968, the Truth in Lending Act had to become a law. These rules weren't already there. When credit cards became a thing, Congress had to act to make sure that banking institutions actually standardized disclosure information for financial products, including mortgages, auto loans, credit cards, and payday lending. Prior to them making sure standardized information was disclosed, banks would just not tell you. They might not tell you how much your credit card rate was going to be before you signed. They might not tell you that it would vary month to month. They might not tell you that it could be changed at any time. The reason why laws like this go into place is because businesses and companies are not citizens. They are a business. They are for their own protection. They are looking out for what is going to be in the best interest of a company, of a shareholder. How do we make the most money? That generally means that they don't want regulations to be able to regulate how they do business. Think about had to pass a law that required creditors to disclose standardized information for various financial products and consumer protections. And now, 58 years later, we are in a world where credit rates are so high, credit card rates are so high that we're talking about passing a law to put a cap on those. Back to the bill. Back to the bill. Be it enacted by the Senate and House of Representatives of the United States of America in Congress assembled, this act may be cited as the 10% credit card interest rate cap. What does that mean? In general, Section 107 of the Truth in Lending Act, 15 USC 1606, is amended by adding at the end the following. So if we go to see this one, Section 107 in general. Okay, we're in general, that's 1601. Let's find 1606. 1606. This is what we would be looking to amend, the determination of annual percentage rate. What they would like to do with this bill is add in at the bottom of this one after E, F1. So we would be looking again, we see E, so then we're going to add an F, that's what they're asking for. Section F, the annual percentage rate applicable to an extension of credit obtained by the use of credit card may not exceed 10 percentage points, inclusive of all financial charges, which we're getting into what are all financial charges. That's very important to add. Any fees that are not considered financial charges under Section 106A may not be used to evade limitations of paragraph 1, and the total sum of such fees may not exceed the total amount of finance charges assessed. 3. The taking, receiving, reserving of charging of credit card annual percentage rate or greater fee than that permitted under this subsection, when knowingly done, shall be deemed a violation of this title, and a forfeiture of the entire interest which the note, bill, or other evidence of obligation carries with it, or which has been agreed to be paid thereon. This is good. This is getting good. This is getting good. What this means, what they're doing here is saying we put in a 10% max on credit card rates for your annual percentage rate. And any of those fees that are additionally charged to you cannot exceed that amount. So the credit card company could not evade a 10% rate of your credit card by charging you so many more fees that you're still paying 20% on your credit card anyway. If they were to do something like that and it was found out and you brought a lawsuit, then knowingly done, that amount, this is how it's reading to me, should be deemed a violation of the title and a forfeiture of the entire interest. So whatever interest had been accumulated over the course of time on that specific credit card would be forfeit. So that's an incentive to the bank to not try to go around. It does have what would happen if a creditor violated the subsection. Nothing in this section may be construed to preempt any provision of state law that provides greater protection to consumers than is provided under this section. This is really important for the United States of America. We have federal laws and we have state laws. So what this is saying is if your state law provides even more protection than a 10% rate or no extra fees or additional disclosures, those things are still in place. There's still a 10% rate cap for a credit card annual percentage rate. And in addition, for certain states that have these types of protections, those also apply. So keeping what states have already voted for while putting on a national level law helps everyone who doesn't have statewide protections. Okay, more technical details, technical and conforming amendment. This is important. Sunset. We use the word sunset a lot in products, in technology. When we say sunset, we mean something is going away, something is leaving. So the sunset of this bill is highlighted here for us, and that's a key word under the technical details. Effective date of the sunset would be January 1, 2031. So the bill would take effect immediately once passed into law, and then the bill would expire or sunset January 1st, 2031, unless Congress decided to extend this specific piece of legislation. Basically, if this law is passed, then the Truth in Lending Act is amended. These additional subsections go under the sections that we already see listed. That is the reading of the bill. Now let's get into what's that quick bill summary that Digital Democracy Project is bringing us, and what are the pros and cons we can also be looking at that are listed here. And then we're going to contact our representatives. It sets a 10% annual interest cap on credit cards, counting all financial charges, stops lenders from dodging the cap with fees. Total fees cannot be more than the finance charges. If the lender breaks that rule, they must forfeit the interest, and people can sue within 2 years to get that money back. Stricter state limits still apply. The cap on these credit cards ends January 1st of 2031. So we have 6 years. If we pass it now, we have 6 years to be able to live through a 10% credit card rate limit. Our observation lens on. Maybe pros that people would see, like, why would this benefit us? Why would this benefit me? Ensuring affordable credit card interest rates allow consumers to make necessary purchases without being overwhelmed by the high interest debt, potentially boosting spending. Another pro, capping interest rates could prevent predatory lending practices, promoting fairer financial markets, and protecting vulnerable consumers from excess charges. Lower interest rates would help consumers save money on debt payments, reducing their financial burden and improving their economic stability. If you think about every time you go shopping and you go to any store, whether it's Costco or Target, if it's Walmart or Amazon, each of those stores, and it seems like every other store you ever go to, asks if you want to sign up for their credit card. You might not have any information at all on that credit card. You have no information at all. They don't know anything about you, but they're asking if you want to sign up to get you to use their credit card, to get you to have points at their store. These types of practices where you give someone the option to have access to money at a rate that they don't understand what might happen if they use that credit card and don't pay off that credit card, or have 10 different credit cards because they always shop at these 10 different stores. That is financial education that we do not have as a mandatory piece of our education in America. So when we're saying predatory here because it is taking advantage of people not having education about a system that will run their life. Because even if you need debt for a really good thing, it is still something that's going to be in the back of your mind thinking about, I have to pay off this debt. That's heavy. 34% of all Americans are in credit card debt. 46% of credit card holders, nearly half of everyone who has a credit card, nearly half of everyone who has a credit card. You take that debt to the next thing. You might not be able to get a next new vehicle or different type of apartment or place to live because you have credit card debt. You might not be able to get a different loan because you have credit card debt. And you might not be able to pay off that credit card debt because at rates as high as 28%, you're constantly only paying on the interest and not on the principal unless you have a big sum of money that you can remove your credit card debt. That's why the word predatory is used there. Lower interest rates would help consumers save money on debt payments, reducing their financial burden. There's a whole lot of things that can just happen in life that we might not have savings for. When those things come up, oftentimes people put them on credit cards. And so if you put $3,000 on a credit card and you have a 24% APR, over 6 months, you are going to pay an additional $250 in interest. That's on top of the $3,000. That assumes that you can even make consistent payments. So if something really terrible was to happen and you were to lose your job for a longer period of time, which we should look at what are the unemployment rates right now and people losing their jobs, not having a job, taking longer to find a job. Say you put $10,000 on that credit card at 24% APR. Over 6 months, the interest alone is going to be between $700 and $800. Over a year, that's over $1,300. So much of your payment starts to go to interest instead of the actual principal. So then that's just how debt keeps piling up. And this can happen especially right now because we're dealing with food prices going up, rent prices going up, health insurance prices going up, wages haven't kept up, and the layoffs are widespread. There are a lot of other things to understand this bill. There's a lot of people who would say, I don't borrow on credit cards. I don't use credit cards. I'll never use a credit card. And they use something else instead. Those are different groups of people. We can look at the data and see how many people use credit cards. So in 2025, 3 in 4 Americans have at least one credit card, at least one. 636 million credit card accounts are open in the United States. And this means something because the population of the United States, around 348 million, and that's the total population, that's not just adults. So this means people who have credit cards likely have more than one credit card, which is this next point. The number of active credit cards held by the average American is 3.7, so almost 4 credit cards per adult. Of everyone who has a credit card is in debt on that credit card. Who are we talking about who has credit cards? Which generations are we talking about having credit cards? There's a lot of boomers in here with some credit cards. So just because someone is older and you may have heard don't ever get a credit card from them doesn't mean that they live by or follow that advice. As you get older and your income stream stops, you might have to use credit cards more often. And we can look at men and women very closely aligned with the amount of credit cards. And if we look at people who are in suburbs, cities, rural areas, and towns, we can see how credit card usage changes through that. This is from Bankrate, which I really appreciate. And wildly interesting, people with at least one credit card, when you look at their incomes, people with higher incomes have more credit cards. We can talk about why that is. And it goes back again to if you have a lower income and you might not be someone who could pay back that credit card, banks are less likely to loan to you. And if you convince one to loan to you, the rate that they might loan it to you at will be higher. And the fees for not paying it would be higher also. So that also diminishes the amount of credit that you could possibly get at a lower income rate. So then you don't have credit to borrow against or credit to use in an emergency situation. And we can see the regions that are in debt the most. When incomes are lower, people need access to money because they still have to live their life. And so a credit card is something that can come in without it being a full loan. If you can't get a full personal loan, if there's not another emergency cash option or family that can help you, the easiest way to make it through whatever situation is in front of you is a credit card that hopefully you could put some money on for a short amount of time and pay off right away. But what happens over time if incomes don't increase, if wages stay stagnant and food prices go up and rent prices go up? We see debt go up. Let's look at what's the cost of doing this? Who's saying no thank you? Why do we want to be hesitant? What are we looking at on the other side of this bill? Potential reduction in credit availability could impact consumers who rely on credit cards for emergencies or cash flow management, disrupting financial flexibility. Now, I want to say when we talk about that potential reduction in credit availability, it's because banks are saying, well, we can't give out as much credit if we can't earn as much money. So if you take away our ability to have a 28% interest rate on a credit card and you cap us at 10%, that limits the amount of money that we can get. So we might not make as much credit available. That's a choice. That's a choice that the banks make. Highlight for you. We don't have all the information listed in here in Digital Democracy Project yet, but the thing that stands out to me already are the amount of banks and bank associations that are opposed to this change. And I think we want to talk about why banks and banking institutions would be opposed to this change and why there would be cross-partisanship and people, we the people on the other side, wanting to decide whether we support or oppose or are neutral on this legislation. But the banks have come out immediately saying that they are opposed to this. One of the biggest things to start to realize and talk about is how do banks make money? And one of the primary ways that banks make money is through interest collected on the various types of loans that they offer. That includes credit cards. There's nothing wrong with wanting to make money, but how do you also ensure that the people we're making the money from are protected as well? So this potential reduction in credit availability, that should be listed there because that seems to be a threat from banking establishments to prevent themselves from having this cap and from this bill moving forward. That's observation only, not a judgment, not a political opinion. That is what the banks are saying. Banks might compensate for the lost interest by increasing their fees for other financial services, potentially adding costs elsewhere for consumers. That is a choice from the banks. So be thinking about who would that benefit, who doesn't receive a benefit. So what this bill does protect is that the bank cannot increase the fees on their credit cards to make up for the difference between 29% and 10% for the interest rate caps. Credit card companies might tighten the criteria, offering credit only to those with high credit scores, restricting access for credit for others. This is another thing that we're seeing from banks saying if you take away our ability to charge excessive credit card fees, we might not give credit to as many people as possible. What we might find is these are empty threats that when a credit card interest rate limit is set, they don't increase those scores. They're fighting against this at this point in time, but maybe they don't actually and tighten down on credit lending criteria. But looking at the fairness of the situation of they're saying who can get access to credit, that's something that we're holding in our hands. Money. Who's keeping it? Who's making it? And who is definitely giving it? What is the purpose of having a credit card? What is the purpose of needing a bank? What are the bank's purposes? Businesses are out to make money. That's what they're for. Shareholders invest in them and buy stock in them because they want that stock to grow at 10%. We can look into how much money all of the business of the banking institutions made these last few years. That might incite some strong feelings as we go through it. So be prepared to understand that businesses in banking are making money for their shareholders. They have earnings. They are bringing in record-breaking profits for their shareholders. They do not pass those on to consumers. You and I are consumers. If you have stock in a bank, you are a shareholder of that bank. You might also be a customer of that bank, and you would be a consumer of their banking products. You could be all three. And to be fair to this bill specifically and to the banks, everything is usually always about money. So when we get into these different bills and we're looking at what's between the lines, money. There's a lot of reasons why people would say the status quo is good for me. There's a lot of people who are fine with how things are. Maybe their credit card works for them. They haven't been laid off from their job. They don't have 5 kids. They aren't sending someone to college. They are able to afford their retirement location. They bought a house in the 1950s and have never moved from it. So, if these are the amount of Americans that are in debt and where they are, how much debt, and at the same time we're seeing banks bring in record profits specifically from interest rates on credit cards being as high as they are, what are some ways we can combat that as an American population? Let's get into it. On the way to VoteBot. It's VoteBot time. Let's go. I need a sip of coffee. All right. It has been a long one. This is an intense bill, and there's a lot of detail to know about it before you vote on it or before you contact your representative to say, hey, what's going on with this? And I want to see it passed, or I don't want to see it passed. I asked VoteBot, hey, give me a statement in support, in opposition, and something that's neutral about this bill, because I want to contact my congressperson, because democracy is us participating in what's happening in Congress, what's happening in our state legislations, because we've hired those people to represent us, right? Okay, so here we go. Statement first in support. I'm writing to express my strong support for S.381, the 10% credit card interest rate cap. With millions of Americans struggling with high interest credit card debt, this legislation would provide much needed relief by capping credit card interest rates at 10%. Such a cap ensures that consumers are protected from excessive rates that trap families in cycles of debt while promoting fairer lending practices. Please support S.381 and stand up for hardworking individuals and families. It's good. Okay, let's read the opposition. Okay, I am writing to oppose 381, the 10% credit card interest rate cap act. While the intention to protect consumers is admirable, a strict 10% cap on credit card interest rates could have unintended consequences. It may restrict access to credit for many individuals, especially those with lower credit scores or limited credit histories, such as lenders. Lenders could tighten standards or reduce credit availability. I urge you to consider the economic impact and look for more balanced solutions. And our neutral statement. I am writing regarding S.381, the 10% credit card interest rate cap act. I understand the bill aims to protect consumers by capping credit card interest rates at 10%. While this could provide financial relief to some, there are concerns about potential impacts on credit availability and the banking industry. I encourage thorough review and consideration of possible effects before moving forward with this legislation. Thank you for your attention to this important issue. So there we have it. Several different ways to respond. All of them are being involved in our democracy. Whether you support, oppose, or you're neutral on this, contacting your representative to let them know that you're looking at it is the step that you can do to be participating. So let's do that next. We're going to go to my favorite. We're going over to ballotready.org. And let's pick a different state today. We have done Washington. We have done Texas. Where do you guys want to be? Ohio? I'm going to meet my representatives because what I'm looking for right now are who are the senators for the state of Ohio. So we need to know every single state has 2 senators that serve in our U.S. Congressional Senate. Doesn't matter what zip code you live in within your state, those 2 senators are your senators. That's why there are 100 senators in our U.S. Senate. 2 senators for Ohio. We have Bernie and we have John. I don't live in Ohio, so I have to contact my senators separately. If we were going to contact John, we could click on his information. Oh, coming soon. Uh-oh. You're not in here, John. So you know what we need to do? We need to go find his info. We would contact John here on his specific state. Get in touch with John, your U.S. Senator. Thanks, John. So we could go to the Contact John button, and from there, we would fill out the information and we would put in our message. I'm going to go do that for my U.S. Senators, and I'll be right back. I've gone to contact my representative. My opinion has been shared. Now it's time for you to go do that exact same thing. This bill is starting off strong with a lot of support of regular voters just like you and I. That doesn't mean that you have to support it. You can have different opinions on this bill too. What we want you to do is be informed and be able to make a decision that works best for you. That's the beauty of America. That's the beauty of democracy. Thank you so much for having a sip with me this week on Coffee and Calculated Curiosity. Show up for yourself, show up for your neighbors. This is how we do democracy. It is something that we do together, and we can keep it if we can keep it. I'll see you next time.